When you buy your morning coffee, that simple act connects you to a vast and intricate network that spans the globe. It's more than just a caffeine fix, it's a small piece of a much larger puzzle. You're seeing the end result of a global chain, a complex web of interconnected systems that bring that cup of coffee to your hands. This chain involves countless individuals and processes, all working in concert. Farmers in Brazil, carefully cultivating and harvesting the beans, are a crucial link in this chain. Their livelihoods depend on the global demand for coffee. Shipping companies, transporting those beans across oceans and continents, ensure that the coffee reaches its destination. The efficiency of global shipping is paramount, and political decisions all play a part, shaping trade agreements and influencing the flow of goods across borders. These decisions can have a profound impact on the entire supply chain. A drought in South America can shrink the coffee supply, impacting harvests and reducing the availability of beans, raising prices worldwide, affecting consumers and businesses alike. This ripple effect demonstrates the interconnectedness of the global economy. The same goes for gasoline. Its price is influenced by factors far beyond your local gas station. A conflict or natural disaster far away, in a region that produces or transports oil, can change what you pay at the pump, sometimes dramatically. These fluctuations can affect your transportation costs and overall budget. Your budget is tied to events in countries you may never visit, highlighting the global nature of our financial lives. These global forces also shape your investments, influencing the performance of companies and markets around the world. The companies in your portfolio are affected by the same international events, facing both opportunities and challenges in the global marketplace. That change your daily costs, creating a direct link between global events and your personal finances. Their profits rise and fall with global currents, reflecting the complex interplay of international factors. Your financial well-being is linked to weather, politics, and a myriad of other global factors, and logistics across continents, all of which contribute to the intricate web of the global economy. Understanding this connection is the first step to being a smarter investor, allowing you to make more informed decisions in an increasingly interconnected world. It explains why markets can seem unpredictable, because they are constantly reacting to a multitude of global influences. They're reflecting a world in constant motion, a dynamic and ever-changing landscape. Even small events abroad can ripple into your everyday life, demonstrating the power of global interconnectedness. The global story is your story too, and understanding it is key to navigating the complexities of the modern world. Tariffs, at their core, are essentially taxes. But these aren't just any taxes, they're specifically levied on goods that are imported from other countries. And the impact of these tariffs hits much closer to home, affecting your daily life in ways you might not immediately realize. Imagine your favorite brand of sneakers suddenly becomes more expensive because it faces a new tariff. You end up paying more for the exact same product, not because the quality has improved or the design is better, but simply because of international trade policies and political decisions. Trade disputes between nations often lead to the creation of barriers, with tariffs and quotas being the most common tools used. These barriers ultimately result in increased costs, not only for companies involved in international trade but also for everyday consumers like you and me. Consider a car maker who suddenly faces higher prices for steel, a crucial component in their manufacturing process. To offset these increased costs, the car maker might be forced to raise the prices of their vehicles, making them less affordable for consumers. Alternatively, they might decide to delay hiring new employees or even reduce their workforce to cut expenses. The level of political tension and the relationships between different countries can have a direct and noticeable impact on your family's budget and the performance of your investment portfolios. For investors, this constant state of uncertainty translates into increased market volatility, meaning that stock prices can fluctuate wildly as markets try to anticipate and predict which companies and sectors will be most negatively affected by these trade disputes. Even companies that aren't directly involved in international trade can still feel the ripple effects of these political tensions and trade disputes, impacting everyone from shipping companies responsible for transporting goods to the retailers who sell them to consumers. In essence, political instability acts like a rock thrown into a calm pond. The resulting ripples spread outwards, eventually reaching and affecting every corner of the pond. This is precisely why international headlines and geopolitical events have the power to move markets and ultimately affect the contents of your wallet. Having a solid understanding of these dynamics can help you better explain and interpret the seemingly wild and unpredictable swings that occur in the market. Global politics isn't just something you read about in the news or see on television, it has a tangible impact on your financial bottom line. So, the next time you notice prices suddenly jumping, remember that it might not simply be a matter of supply and demand, it could very well be the result of a recently imposed tariff. Your spending power, the money you have available to purchase goods and services, is always on the front lines, directly affected by the ever-changing landscape of global trade. When global crises hit, the world watches with bated breath. Uncertainty looms large, casting a shadow over financial markets and economies worldwide. In these moments of turmoil, fear takes over, and investors, both seasoned professionals and newcomers alike, run for safety, seeking shelter from the storm. This flight to safety means selling risky assets, often at a loss, as investors prioritize capital preservation above all else. They're looking to minimize potential damage to their portfolios, and buying what feels secure, assets perceived as havens of stability amidst the chaos. This is where the classic safe haven assets come into play, like U.S. Treasury bonds, which are backed by the full faith and credit of the U.S. government, making them a popular choice during times of uncertainty. Or gold, the age-old store of value, often seen as a hedge against inflation and currency devaluation. Its tangible nature provides a sense of security. As money pours into these safe havens driven by widespread fear and uncertainty, their prices rise, sometimes dramatically, reflecting the increased demand. While stocks, particularly those of companies perceived as vulnerable, often tumble, as investors reduce their exposure to riskier assets. The domino effect is clear, a chain reaction of fear and selling that can quickly spread throughout the market. Crisis sparks fear, igniting a wave of anxiety among investors who are unsure of what the future holds. Fear triggers selling, as investors rush to liquidate their positions in risky assets, exacerbating the market decline. And markets drop, sometimes precipitously, creating a sense of panic and uncertainty. Even strong companies with solid fundamentals and long track records get caught in the sell-off, demonstrating the indiscriminate nature of fear-driven markets. Simply because they're seen as risky, regardless of their actual financial health or long-term prospects. For long-term investors, understanding this pattern is crucial, as it provides valuable context for navigating market volatility. It explains why markets fall fast during global shocks, often much faster than they rise during periods of economic expansion. Staying calm when others panic can reveal opportunities, allowing you to buy quality assets at discounted prices. The market's reaction is often emotional, not rational, driven by sentiment and herd behavior rather than fundamental analysis. Recognizing the psychology of fear helps you avoid rash decisions, preventing you from selling low and missing out on the eventual recovery. Sometimes the best move is to hold steady, resisting the urge to panic and allowing your long-term investment strategy to play out. Safe assets may rise, offering a temporary sense of security, but panic selling rarely pays off in the long run, often leading to significant losses. Know the pattern, understand the flight to safety, and you'll be better prepared for the next crisis, equipped to make informed decisions rather than emotional ones. In chaos, knowledge is your best defense, empowering you to navigate market volatility with confidence and potentially capitalize on opportunities. Money flows like a river, always seeking safety and growth. When a country is stable and innovative, capital pours in, fueling growth and rising markets. But risk, a scandal, new regulation, or conflict can send that river elsewhere overnight. This capital flight can weaken currencies, hurt stock markets, and make borrowing harder. When foreign money floods in, your investments in that region can soar, but when it flees, prices fall fast. Bonds are affected too. Confidence brings low rates, fear brings high rates or no lending at all. These flows explain why some markets boom, then suddenly bust. It's not always about company performance. Global risk perception matters. For investors, global diversification is key. Don't put all your money in one place, spread it out to weather sudden shifts. The world's capital flows are powerful, ride them wisely. Diversification protects you from the river's sudden turns. Inflation means your money buys less, and global events can make it spike. A war or disaster can raise energy prices, pushing up costs everywhere. Central banks fight inflation by raising interest rates, making borrowing more expensive. Higher rates slow spending and cool the economy, but they also impact your investments. When rates are low, stocks usually do well. When rates rise, bonds become more attractive. A rate hike in the US can ripple worldwide, strengthening the dollar and forcing other countries to react. These moves affect your portfolio, from stocks to international funds. The world's financial system is deeply connected. A decision in one country can change investment values across the globe. Understanding inflation and interest rates helps you navigate market swings. Your returns depend on more than just company profits. They're tied to global economic currents. Stay alert to the world's financial pulse. Your cost of living is shaped by global forces, not just local prices. A drought in Brazil or a factory shutdown in Asia can raise prices for coffee, cars, or electronics. Supply chain disruptions create scarcity, driving up costs and causing delays. Rising expenses mean less money to save or invest. Inflation eats into your returns. If prices rise as fast as your investments, your purchasing power stalls. Global instability acts as a hidden tax on your future. That's why investing for growth is essential, to outpace rising costs. A solid budget and emergency fund help you weather sudden spikes. Your financial plan must be resilient, not just opportunistic. Global shocks start far away but hit home fast. Build a plan that can withstand them. Technology is now the world's most powerful economic force. Software, data, and digital networks cross borders, creating global opportunities for investors. A developer in India can work with a team in California. A business in Kenya can sell to Europe online. Tech innovation spreads value worldwide, opening new investment frontiers. But with opportunity comes risk: cyber attacks, data privacy battles, and political fights over tech dominance. Regulation can be as important as innovation for a tech company's future. Technology isn't just a sector, it's transforming every industry. The best companies use tech to gain an edge, from manufacturing to healthcare. Investing in technology is now essential for long-term growth. Look for firms using digital tools to lead their fields. The global tech trend is reshaping the investment landscape. Ride the wave, but watch for new risks. The shift to clean energy is one of the century's biggest economic changes. Climate concerns and new tech are driving a move from fossil fuels to solar, wind, and electric vehicles. Trillions will be invested in rebuilding energy systems worldwide. This creates huge opportunities for companies and investors in green tech. Governments and consumers are pushing for cleaner solutions, giving these companies a tailwind. But traditional energy firms face risks if they don't adapt. Investors now weigh climate risk when judging a company's future. The transition will take time, but exposure to clean energy is smart for a diversified portfolio. Investing in sustainability aligns your money with a powerful, long-term trend. It's a chance to profit while helping solve global challenges. The world is unpredictable, but investing doesn't have to be overwhelming. You don't need to be an expert, just follow a few timeless rules. First, diversify. Spread your money across assets, industries, and countries. Diversification shields you from shocks in any one place. Second, focus on quality. Own strong companies with solid finances and good management. Quality businesses weather storms and thrive long-term. Don't chase trends. Hold assets you believe in for decades. Finally, control your emotions. Markets swing wildly on global news, but panic selling is rarely wise. Stick to your plan and remember why you invested. History shows markets recover from crises. Stay calm, diversified, and focused on quality. That's how you let the global economy work for you.